We have two objectives with the Nedgroup Investment Opportunity Fund. The first is to try and achieve inflation plus 5% over a rolling 3-year period. And the second objective is to not lose capital over a 24-month period. Now, on the first objective, since inception, we've been able to achieve inflation plus 7. So it's been quite a nice environment from a return point of view. I think going forward, it is going to be a tougher objective, but we still think we've got the tools to achieve that. So we think the Opportunity Fund is quite unique in the sense that we've got a definite focus on trying to identify asymmetric return products and investments. And what we mean by that is we're trying to get investments where the downside risk is limited, but it still gives us the opportunity to participate in the upside. And we think the more we get some of those instruments, we're going to lose out to some of the upside potential, but over time the compounding and missing out on those big holes will result in us achieving our two objectives. So the Nedgroup Investments Opportunity Fund is run a bit differently than other balance funds. We've got a definite focus on downside protection and trying to achieve that upside participation. So that's investing in asymmetric return type of investments. We look to have a very diversified portfolio to further reduce risk. We put a lot of derivative structures and hedges over the portfolio to reduce risk. And then we look at hybrid instruments, which gives you bond-like returns on the downside, but equity-like returns on the upside. So we think it's quite a unique approach to running a balance fund, and time will tell. We started the year with 53% in equity exposure. We've reduced it slightly to about 51% at this point in time. But in addition to that, we've put hedges of about 20% of the portfolio. So if the market should fall, our equity exposure will reduce with the market as it falls. So one of the shares that we've put a hedge on to protect against downside is Naspers. As you know, Naspers has always been one of our top holdings within the fund. It's done fantastically well for the fund. And at this point in time, we think there could be a bit of volatility risk. And we've put a hedge over Naspers. So for the first 10% of the fall in Naspers, the fund will be protected. But putting that hedge in place enables us to participate in another 10% upside from here. And we think that's a nice risk return profile. In the long term, we still really like the Naspers investment case. In the short term, it's done fantastically well. I think year to date, it's up 35% or the like. So we think there's a bit of price risk. Tencent is reporting the results soon. There's been a big focus by international investors into the IT space. So there's a bit of a hype there at this point in time. So even though we still like the long-term fundamentals, short-term, we think there could be a bit of risk. So we're sitting with a cash weighting of about 9%, which people don't always appreciate the optionality value that you get sitting on that cash. So if you do see a sell-off in some assets, you've got the flexibility to increase your exposure to that specific asset class. So we think cash you've got an option value on it. The other thing to remember about our cash holding is we also manage the Nedgroup Flexible Income Fund. So although it says cash, we're always looking for near cash instruments that enhances the yield slightly. So over time, we've been able to achieve returns of cash plus 1 to 2% per annum. So our property exposure is close to 9%, 1% in SA with 8% in the UK. And the reason why we prefer UK over SA is UK property stocks post-Brexit sold off significantly. They're trading at discounts to net asset value of 25 to 30%. At the same time, the pound is trading at a 50-year low relative to the dollar. So we think you're getting a hard currency exposure at quite an attractive discount to net asset value. And so far, post-Brexit, those net asset values have actually held up quite well. They're trading at dividend yields of 4.5% to 5%. So we think it's quite an attractive investment that gives good diversification benefits to the fund as well. Gold has got a lot of characteristics that makes it an attractive investment for a balanced fund. It's an insurance policy. It's a rand hedge. There's a lot of geopolitical risks out there, which also makes gold an attractive investment, and it's a nice diversifying asset. But saying that, our exposure to gold is still relatively small. It's just over 1%, so it's not a big bet that we're taking on gold really doubling from here. It's a good diversifying asset for a balanced fund. So the effective duration is very close to zero. We see there's a lot of risk with our South African government bonds, and at the moment, offshore investors are throwing money at South Africa to get the yield, but we don't think they appreciate the fundamentals of South Africa and the risk with the high debt levels that we're running at, and that debt is increasing. Now, once you get to about 60% debt to GDP ratios in an emerging market, it's a red flag, and we are there now. If we continue on the current trajectory, we could be at 80 to 85% in 3 years' time, which we think will be quite negative for bonds. Because of that, we've got a very low duration. We see currency as a separate asset class. At this point in time, on our models, we've got a fundamental model that we value the rand on, and on our models, the rand is slightly overvalued. So we prefer to have as much offshore exposure at this point in time. But there has been times in the history of the fund where we've thought the rand was oversold, and we've hedged the currency back to rands, our offshore exposure. So we think it's an additional asset class that you can generate alpha from. Last year, we had a currency hedge against a strengthening rand, which added about 2% to performance within the fund. So we've got about a 10% exposure to Euro stocks notes, and it's probably the most exciting part of the portfolio at this point in time. And why do I say that? One, it's an asymmetric return product. So again, one of those products that we look for where the downside is protected, but it gives you upside participation. And we're at that level where we're starting to participate in that upside of the Euro stocks. And not only on a 1-to-1 ratio, at over a 2 times ratio, which means that if the Euro stocks continues to go up from here and it goes up by 10%, our Euro stocks note exposure or the return will go up by about 20%. Now, why are we excited about Euro stocks? Well, over the last 5 years, the Euro stocks have significantly underperformed the American market, the S&P. At the same time, you've seen the euro almost halving relative to the dollar. So Europe's become a lot more competitive, and a lot of those companies earn their revenues in dollars. So as the euro has weakened, it's actually been quite good for their profits. So we're starting to see earnings upgrades coming through in Europe, which bodes well for earnings forecast. And on the back of that, we've got a positive view on the euro stocks, and not only a positive view, if it performs well, we'll get some geared benefit to it. So if you look at global markets, all yields are very compressed. It's been a market that's been artificially stimulated by very low interest rates, and we are moving into an environment where interest rates are going to go up. So the impact on valuations of different asset classes is still unknown at this point in time. So we think there's a lot of price risk out there. Whether it's US government bonds or global government bonds, whether it's currency or whether it's asset classes like equities. So we think to be in a sort of a low risk balance fund, hedge some of those risks out while still giving you the opportunity to participate in some of the upside. One of the major opportunities that we see currently is the Euro stocks market. For that reason, we've got the 10% exposure to Euro stocks notes, and it gives us the geared upside potential. Another area is in South Africa, your yields are still relatively high, and we look at doing corporate credit notes where we don't only get the SA government bond yield, but we get a spread above that. So we've got no government bonds, but we've got some corporate credit where we think we can get some nice yield pickup. There are also some very attractive other yielding assets like Royal Bafokeng Platinum convertible, which we've recently invested 3% in. Pays you a coupon of 7% per year. Plus it gives you upside participation if the share price should increase by more than 35% or 30% over the next 5 years. So a very attractive yield plus equity upside should it perform.